Good morning, everybody. Welcome to this webinar brought to you by Wealthford, sponsored by Macquarie Warrants Malaysia. Today, our webinar title is Navigating the Tariff Turbulence. So, my name is Shen Chu. I'm the moderator for this session. So, thank you for spending your precious morning today with us to join this webinar. We promise that we will do our best to make it well worth your time. Now, the global trade tensions are heating up again, okay, and tariffs are now back into the spotlight, okay, as I think yesterday, US President Trump has voiced his dissatisfaction that China is not doing much to honor their trade deal, and he's also double the steel tariff to 50%, okay. So tariffs are now back in the spotlight despite the 90-day truce. So the rise of tariffs and an ongoing trade tensions can feel like unpredictable headwinds. So leaving us wondering whether our portfolio is secure or not, and how should we navigate this kind of turbulence, right? So in this webinar, we will discuss about all these tariff impact. We have two speakers in this session. So the first speaker, PC Wong, will share with you the impact of tariff and the outlook on the US and the gold market. Now, meanwhile, our second speaker from Macquarie Warrants Malaysia, Afiq Suhaimi, will share with you how structural warrants can help you navigate this volatile market, be it a bullish market or a bearish market. Now, before we begin, disclaimer, whatever we share in this session is only for educational purpose, so in no way that I give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you're solely responsible for all your investment risk. Now, allow me to briefly introduce our first speaker. So he graduated from National University of Singapore in 1989. He has more than 27 years of working experience with several public listed and international companies. He's the author of Invest in Foreign Shares, which reached Popular's top 10 non-fiction bestseller in August 2014, and Invest in REITs and Global Economic Collapse. So he's a full-time investor, author, and trainer, and have been investing in Bursa and international markets since 1995. He is the invited speaker by Bursa Malaysia, UOB, Kay Hian, Hong Leong Investment Bank, RHB, Kenanga, and Inter-Pacific Securities to train their retail clients in investing. So he also appeared on several media and featured in a column in the Sinchu Finance segment. So he's none other than Mr. PC Wong. So PC, good morning. How are you today?
Hi, good morning, Shane, Afiq, and those who are logging in on this morning.
Right. So I'll unshare my screen and you may proceed with your screen sharing.
Okay. So our topic today, navigating the tariff turbulence. So what we will be covering is discussing about Trump tariffs and their impact on the global economy as well as the US economy, historical trends of a tariff economy, understand China's retaliatory actions and how they impact the US economy, key markets and how they will likely to react is the US market, Hong Kong market, and gold. Then we look at comparative performance between US market, Hong Kong market, and gold, and key changes to policies which could turbocharge gold's rally. So let's look at Trump tariffs and its impact. Now, the current tariff is at 30% with China on Chinese goods for 90 days, and the 20% tariff is to force China to limit the flow of fentanyl to the US. But from what I gather from Trump's post last night is that he could be reviewing the tariff because he says he's no playing Mr. Nice Guy anymore. So China's reciprocal tariff is 10% on US goods. And besides the tariffs, there are trade limitations imposed by the US against China and vice versa, especially on the US with regards to the chips. And as of yesterday, on tariff, restrictions on the sale of aircraft engines to China, because China is also developing its own commercial airliner, but some of the engines are still being made possible by arrangement of purchase of US and French engines. So that could impact China, and China's retaliation is with regard to rare earth minerals, which are very vital to the US economy. Then we have the de minimis tariff on 50% for goods up to $800 for parcel shipments. And current tariffs on the rest of the world still stands at 10% on all imported goods, and reciprocal tariffs higher than 10% on the rest of the world will be suspended for 90 days. Canada and Mexico still face 25% tariff for all exports which are not compliant to the USMCA, and total effective tariff for all imports is 22% in the US. Now, the US has also announced a 50% tariff on the EU, but that has not been made official in a sense that it has been delayed from June to July. So a lot of discussion will be ongoing in the next few weeks. So let's look at on the US trade. Now, definitely where the US is concerned, the tariff will actually affect global trade, where free trade with the US is under siege. That means that a lot of countries that have trade with the US on the global scale, but right now is under siege because it also means that it has become more expensive for them to, for US to import from the world. While reshoring could happen, it is not the US interest to reshore labor-intensive and low-value manufacturing. And to that extent, I think you see a bit of contradiction, mainly because the US want to bring back manufacturing to the US because they say that they want to create more jobs. But if we want to look at the modernization of manufacturing, it actually has lesser jobs because a lot of it is now involved in a lot of manufacturing involved the using of robotics, sensors, and also efficient monitoring systems that previously would require human labor. So modern manufacturing, even though if it comes to the US, will not create the kind of jobs that is expected. Okay, so we could see higher possibility of friendshoring, shifting of manufacturing to US-friendly countries, so that to avoid those from countries that face higher tariffs. And US will focus on high-tech manufacturing because only through high-tech manufacturing can the US add value to the entire chain. Now, on the global trade, some countries will become transit points to bypass the tariffs. And there is no one-all solution. That's why some countries would actually import components from China, assemble in the local country, and then ship it elsewhere. So that could be a challenge in trying to, for the US to impose that how to prevent Chinese manufacturing from being exported to the world. Now, one classic example is when the sanction on Russia oil, but Russia oil still is being shipped to India, that is refined and then sold to the EU. So there is no one stop to prevent goods from moving, because as long as there's demand, there will always be a shipment of goods. So the tariff could ignite nationalistic behavior among countries as they prioritize the pursuit of self-sustainability. For example, China. China right now is increasingly become more self-sustainable. If you follow the development of chips industry in China, you can see that they have come up with their own version of chips, version of semiconductor manufacturing equipment. So could lead to the enlargement of BRICS Plus and the establishment of new economic blocs as countries seek to achieve free trade among themselves. So amid the Trump tariffs, like recently we have China with ASEAN having a version 3 of their trade agreement, which will cover a much wider scope. So in terms of supply chains, now in the coming 60 to 70 days, there will be a mad rush to stock up by US retailers. Now, this will be similar to the post-pandemic situation where the rush to secure goods will force the cost of shipping higher. In fact, a lot of container shipment, the price per shipment right now of a 20-foot container has now risen because of sudden surge of demand from China to the US because of a reduction in tariffs. So manufacturers in China could jack up their prices due to increased cost of production to meet the pent-up demand. And regardless of what the US say, China is still the world's manufacturer, and there are limitations where the US can secure its supplies of goods other than from China. So you can see here that China's manufacturing output is 4.16 trillion, whereas the US is just 2.49 trillion. So the Chinese are actually outproducing the US by a factor of 0.5. And you can see that Germany and India collectively is even a smaller portion than China. So that means that no matter what, the US will still depend on China for a lot of goods. And to impose tariff would lead to a lot of distortion, okay? In the US, it will distort trade. It will also distort the supply chains. Now, the US has levied a 25% tariff on aluminum and steel. China still export automotive and aerospace components to the US, which are subject to 30% tariff. Now, the above could impact the automakers and aerospace companies, resulting in higher costs of production and potential layoffs. In fact, some of the auto manufacturers in the US recently have announced some layoffs. So tariff can also result in hoarding by wholesalers and retailers, which is detrimental to the consumer. But with the tariff, when it was at around 145%, there were an influx of American buyers into China where they I've seen photos where the queue is so long, buying lots of goods from China because China has also announced an immediate refund on the VAT paid by foreign tourists at their convenience, okay, not only at the airport. So that makes it much easier for the people to buy the goods because they get back their cash very fast. So, but if the tariffs continue to be fixed, let's say at 30%, a lot of wholesalers and retailers will start hoarding their goods because for fear that the tariff may go up higher, especially since that Trump announced that no more Mr. Nice Guy. So that means that a lot of retailers, wholesalers would be even more have even more urgency to bring the goods in. Small and medium-sized companies may not be able to afford the tariffs, resulting in many being forced out of business, thus pushing unemployment higher. Many are involved in the supply chains by importing intermediary goods. Now, the big corporations are not the biggest employer in the US. Small and medium-sized businesses form the largest pool of employers in the US. Now, if they cannot sustain alongside with the tariff, then there will be more bankruptcies. In fact, the bankruptcies for the month of April actually went up by about 9% year on year. Now, the other impact on US economy will be inflation. US tariffs will lead to higher inflation in the US as importers will be forced to pass the cost of the imports to the consumers. Now, the Trump admin keeps on insisting that it is China who's paying the tariff. Nothing can be more untrue because China just sell the goods and is taxed in the US. So China wouldn't be paying that tax. And that is why the importers will be passing along to the, whether it's manufacturers who import components, okay, that cost will be passed on to the consumer. So the US CPI at 2.3% in April has not moved the Fed towards a rate cut. This is because the Fed is expecting higher inflation ahead due to the tariffs. In fact, Powell commented that Trump tariffs will result in higher inflation, slower economic growth, and higher unemployment, which is the epitome of a stagflation. Although Powell never say it's a stagflation, but he is putting forward the ingredients that make up a stagflation. Now, in terms of economy, tariffs will reduce consumption due to the impact of inflation. US face diminishing consumption owing to record high household debt, consumer card debt, and high cost of servicing this debt. Not only that, but recently reports have shown that the US have a policy, retailers selling the concept of buy now, pay later. I think in Malaysia, we are also having that among the retailers. Okay, buy now, pay later has resulted in the most having a lot of the consumers now racking on debt, of which the delinquency level have increased tremendously. That means that they do not have money to pay off their purchases. That is why the debt becomes delinquent. So when the consumers are fully tapped out of whatever that is viable to consume, then consumption would come down. And where the US economy is concerned, it thrives on about 67 to 70% of consumption. So even the newly introduced buy now, pay later is facing increased delinquencies. Meanwhile, the US banks are burdened by almost 500 billion in unrealized losses arising from the destruction in the value of bonds held in their balance sheet. So banks actually hold US bonds as an asset. So when the yields spike and yields are inverse to the value of the bond, that means the bond value has come down. So what it means is that those bonds that US banks have bought at a much higher price are now valued much lower. And that's why they have unrealized losses. So it has been hovering between 400 to 500 billion. Okay. And recently it spiked up to 400 over billion. Not reaching 500, but on the 400 plus. So that is not being reported in the income statement and is parked just as an off item in the balance sheet. It's not marked to market. Now, if let's say they were marked to market, then US banks will actually face a major loss. So on top of that, there's the ongoing commercial real estate crisis and a potential housing crisis 2.0 at a time when global economy is saddled with record high debt of 324 trillion. Now, the commercial real estate market is nothing new, okay? Throughout last year and to this year, commercial real estate are being sold between 60 to 80% discount of the purchase price because of deteriorating economic condition. And right now, the amount of houses that are put on sale has been escalating in the US. And why is that? Because the consumers are tapped out of credit, they borrow money against their real estate to finance their consumption. And right now, even every part of the debt has become more expensive because of rising bond yields. They have no option but to sell their real estate. And that is why there is a potential housing crisis 2.0. And the US debt is now on the threshold of reaching 37 trillion, of which about 8 trillion of debt is required to be refinanced this year. So rising bond yields in the US is a recipe for disaster, and not surprisingly, Moody's downgraded US debt to AA1, finally losing its pristine AAA rating. So let's look at a historical trends of a tariff economy. Now we have the Gilded Age from 1970 to 1913. This is the age where Trump tries to emulate. During the Gilded Age, the US maintained a high tariff system with average tariff around 35%. These tariffs were designed to shield domestic manufacturers from competition from foreign goods, particularly in sectors like textile, steel, and iron. The period of high tariffs coincided with a period of rapid economic growth and industrialization in the US. And this was during the first industrial revolution, which led to the belief that tariffs were crucial for this development. The rapid economic growth was driven by rapid population growth due to inflow of immigrants and transformation from an agricultural economy towards a sprawling industrial system. This was the period where Ford actually came out with the line production, okay? And that's when US Steel has become a big business, making many of the current third generation of wealth, for building the wealth for the third generation, okay? And a lot of universities and institutes were named after a lot of all these wealthy people. However, poverty was widespread, while barons of phenomenal wealth held tremendous sway over politicians who often helped boost their financial empires. So this was the Gilded Age. Then we have the Smoot-Hawley Act from 1930 to 1946. The Smoot-Hawley Tariff Act, signed into law in 1930, was a protectionist trade measure that significantly raised tariffs on imports into the US, intended to protect domestic industry, particularly agriculture. By raising the average tariff by 20 on top of the pre-existing 40%, it prompted retaliation from foreign governments. Within 2 years, some 24 countries adopted similar beggar thy neighbor duties, making worse an already beleaguered world economy and reducing global trade, leading to the Great Depression. The tariff faced significant criticism and was finally repealed in 1946. The act is often cited as an example how tariff can lead to trade wars and retaliatory measures from other countries. So this is more the likely scenario we are seeing now. Then let's look at what is transitioning between the Gilded Age and the Great Depression. So the Gilded Age was known for rapid industrialization and economy supported by population growth. What changed was the creation of the Federal Reserve in 1913, which started the growth of a debt-based economy. This led to the roaring 1920s, which is 1920 to 1929, which saw the development of new industries like the automobile industry, fueled economic growth and mass production. This period saw a significant increase in consumer spending and leisure activities, leading to a sense of prosperity and optimism. It all ended when the crash of 1929. Subsequent measures to protect US economy led to the introduction of the Smoot-Hawley Act, which soon led to the Great Depression. So it often starts with a lot of euphoria and speculation because it's driven by and financed by debt. For example, what we have in the US is that over the last decade plus, US has been, US thrive on its financialized economy. Why? Because corporations were using debt to buy back shares to boost the share price instead of using it to expand productivity or expand R&D or even expand the plant. Because that would, if you expand the plant, that would actually bring down the price and lower the consumption, thus making consumption more feasible instead of paying much higher price. So because of a lot of money goes into financialization of assets, there is less that goes into the productivity of manufacturing. And that is why you see that the US economy has fallen short compared to China when it comes to its manufacturing capacity. So what is different this time? As I mentioned, today the US industries have been hollowed out and it does not have the infrastructure nor the talent to re-industrialize. For example, the accident involving the bridge, I think in a bridge, I think in Brooklyn, I could be wrong. The bridge has not been repaired yet, okay? And it has been so many months. So that goes to show that US doesn't invest in the infrastructure because it's not profitable. And here is one glaring example. This is the electricity generation between the US and China. And you can immediately tell that industries need to be powered by electricity, without which could stall the development of industries in specific countries. So you can see that China's electricity generation has far surpassed the US, and the US has remained pretty stagnant. And if let's say you want to build your industrial base, but you do not have the infrastructure, then your industries cannot be developed, especially if you want to transition back into a manufacturing giant. So that goes to show that the US doesn't invest much in infrastructure, and a lot of the infrastructure right now is crumbling. The US has 37 trillion debt, but none of it goes significantly into infrastructure. A lot of the Chinese debt, for example, the public debt of China is about 60 to 80% of its GDP is being channeled into infrastructure and development of the social security net. So that is why China can continue to become a major superpower in terms of manufacturing. So the US runs a debt-driven economy, which is highly financialized. Corporations borrow money to buy back shares instead of expanding R&D, production capacity, and develop talents. Right now, the US is even revoking visas of international students who want to study in prestigious universities. Now, what transitioned the US into a major superpower in the late 1800s to the 1970s was because a lot of influx of foreign talents that helped to develop its tech sector. And if you, let's say you remove international students from coming in, that means the US would not have the influx of brain power into the country. And therefore, development of talents will be negated. So the US, being a reserve currency, demands that exporters keep surpluses in order to invest in US dollar, to invest the US dollar in US treasuries, while enabling the US to rack up debt. So the US prints paper money in exchange for goods, and this can only happen when there is a trade deficit. So Trump likes to say that if we don't trade with China, we have no trade deficit, and therefore we are a win. No. When they trade with China, the win is that in actual goods, whereas China only received the paper money. And that is how distorted the philosophy has become. Now, the US does not have the means to win a tariff war because it does not have the manufacturing capacity in its current form, whereas it has taken China many decades to build its manufacturing capacity to its current form. So the industries would not change overnight. Okay, for example, the US election is every few years. So if corporations make an investment into a facility in the US where it has become more expensive, it will take a few $billion. If let's say it's a very wide manufacturing concern, then what will become of it when the when Trump's presidency ends, will the new president implement something that is totally different and therefore put the corporations at risk of their investment? That is why this form of tariff war, the up and down and flip-flops, can be very damaging for companies because it affects their planning. So let's understand China's retaliation. Although China has 10% tariff on US goods, they are restricted mainly to products which can readily be substituted. Now, the US imposed tariff, not tariff, but sanctions, on selling technology to China. But if you don't sell the technology to China where China actually wanted it, how can you balance the trade deficit? But US can say, okay, you buy our oil, you buy our commodities, but then China has found alternatives, such as soybean from US from US, China is now buying from Brazil, and beef from US it has come to Australia, and oil, China is buying from Canada and Russia. So China intends to substitute Boeing with its homegrown aircraft, the COMAC, and China is also developing the entire semiconductor value chain to become fully self-sufficient. In fact, in the most recently released article on the development of high tech in China, they set a target that by 2028, China need to be 85% proficient in self-sufficiency. Now, during the Made in China 2025 target, China only aims to achieve 70%. And right now that has been achieved. China now is moving to 85. So I believe that by 2030, it will be 100%. China is not going to redevelop the chip industry like what the silicon-based chip industry like what is currently being controlled by the US. China has already developed new gallium chips and also single atom chip, 2D chip, which will actually shift the balance from traditional to modern. So all these are actually being developed right now in China. And China has used a different light source to develop its own EUV and not copying ASML. So US trade deficit with China will remain pertinent issue in the forthcoming negotiation. Because China is not going to balance it if, let's say, US doesn't allow China to buy technology. So China is actually prepared to walk away from the US because the export to the US right now constitute only a few small percentages of total China's GDP. China's trade with Latin America, with Africa, and Southeast Asia have gone up much higher in April, despite the fact that its export to the US has fallen 21%. And China still have growth in its exports. So in retaliation to the US tariffs, China has also restricted the export of rare earth minerals and their finished goods. Means rare earth minerals finished goods here, which means the magnets, the refined ore itself to the US. So rare earth minerals are used in magnets, without which electronics and vehicles or equipment cannot function. Now, if we are listening via our headphones, it's because of the magnets inside that cause the vibration that discern the audio. So everything that we own that is electronic will have some magnets in them. So they are used in semiconductors and in a variety of equipment in the military industrial complex. Now, this could cripple the US ambition to reindustrialize. So assuming now cars themselves require magnet. So if there's no rare earth to develop those magnet, that means the aerospace industry, that means that the automobile industry will be affected. So this is just a look at China, how China corner the rare earth market. So China's reserve is the world highest, okay? And China has a share of 68.9. Now this is by production by country. But if we zero in on refined finished product, China is closer to 90%. So that is why China is playing the rare earth mineral playbook, while the US play on chips and high technology exports. So this is going to be a tit for tat. So how key markets will react? Now, major stock markets reacted positively to the US trade deal with China, albeit being for just 90 days. Risk of uncertainty after the 90 days expire. In fact, we no need to wait for 90 days because just yesterday, Trump tweeted, no, Mr. Nice Guy. Does it mean that he'll up the tariffs on Monday? We do not know. So the market rebound we just witnessed could be at risk within the next 8 weeks. That is presuming that Trump wouldn't come up with anything that is going to raise the level of risk to investors next week. Also, the risk of inflation leading to a drop in consumption could hamper the US economy and affect other economies. Global stock markets could be negatively impacted as a result. So people used to say, when the US sneezes, the whole world gets a cold. So US losing its AAA rating is a big thing because it raises the cost of financing its bloated debt. This is not good for the US dollar, which could push the yen higher. Now, risk of triggering a reverse yen carry trade. This happened, okay, most recently when the yen suddenly spiked against the US dollar. Because a lot of huge investment funds, they borrow yen because yen is very cheap, okay, due to the very low interest rate, and then they use it for speculation. But if the yen becomes higher, that means that in view of the current risk, for example, the S&P has come down quite significantly since reaching its peak, then they could be deeper underwater. And when the reverse yen carry trade is done, it could cause a market drop quite badly. I think we actually experienced that last year, if I'm not wrong, okay, where the market dropped quite significantly. Now could affect Trump's policy with regard to tariffs, especially when Trump is touting a new tax bill to cut income tax on those earning less than 200,000 overtime and tips. So if US is going to lower the government's revenue to push consumption, then what happens in the need to refinance the trillions of debt that is due this year? So the Trump admin could be pressured to bring the cost of financing down, and that means higher tariff could be back. So the most urgent thing that confronts the Trump admin right now is the refinancing of US debt. If the rates are not being brought down, the cost will escalate. Already, the rolling 12-month interest payment on US debt is 1.36 trillion, if I'm not wrong, a year, which measured against the US income tax currently, which is closer to 5 trillion. So that is a huge percentage of the revenue that goes into the interest payment. So if they cut away the income tax, that means that 5 trillion, almost 5 trillion of revenue would be further brought down. So that creates undue pressure on US debt, and that could also push the yields even higher. So the most urgent thing I believe that the US is facing right now is refinancing its debt, and that is why there is an urgent need to bring the yields down. So the downgrade of US debt could trigger a number of risks. US decline in value, US treasuries decline in value, leading to higher yields. The decline in US treasuries risk widening the unrealized losses in US banks. Rising yields could force the Fed to raise interest rates at a time when the US is facing a commercial real estate crisis, rising delinquencies in student, auto, and credit card debt. The tariffs has also increased the likelihood of higher inflation. However, as consumption collapses as goods become unaffordable, we could see many companies fail, resulting in mass layoffs. So the best case, according to Jamie Dimon's warning, is that the US would face a recession. A worst case would be stagflation, where Powell has already mentioned in his speech. And worst case, inflationary depression. Now, this is a worst case scenario painted by Peter Schiff. Now, Peter Schiff is a well-known economist. He has a lot of followers. They are in the millions. Okay, so the Fed will be forced may be forced to step in and launch a massive QE before everything hits the fan, but this will result in a hyperinflationary spiral. Now, we need to be aware of the black swan, which is the reverse yen carry trade. So if we look at the US market through the crisis, this was during the Great Depression, okay, where the market fell 83%. Now, if we recall, the Great Depression started because of the Smoot-Hawley Act. And it takes many years from the Great Depression, okay, from 1932 for the market to reach back its equilibrium, which is sometime in 1946. So that means more than a decade. And if we go to the 1970s stagflation, okay, the market actually fell. This was during the stagflation. The market actually fell in the oil shock of down 43%, which is due to the stagflation. So after a few years, then it started to trend back up. And if we look at the Great Depression, the Great Recession, it was down about 51% before it stabilizes a few years later, and then it moved up. So depending on the US market, over the longer term, yes, it will go up. But if, let's say, the crisis is as worse or worse than the recession, the Great Depression, then it may take a longer period. So we are right now in a very uncertain period. So what follows will depend on the Fed. But the Fed is already conducting stealth QE. And here are some reports, okay, that the Fed is secretly buying some treasuries. In fact, it is a bit of an interest for you to know that not only the Fed is buying treasuries, but the US Treasury Department has indicated that they are prepared to raise treasuries, raise money by selling treasuries to buy back treasuries. So that is telling you how severe the crisis is, but then they are keeping it under tap, okay, with a lot of news that talk about how everything is stable, okay? The Fed will always step in to prevent a major crisis. So we will be unlikely to see it getting into a similar Great Depression, okay, or to that extent like the Great Recession, because the Fed has learned from its mistakes that it is ready to step in. But this will cause the US dollar to lose its purchasing power even more, resulting in a hyperinflationary environment. So that means that the Fed will conduct QE similar to the BOJ. And look at what is happening in Japan now. Rice in Japan right now is at a record high. Okay, if you look at commodities, just do a search on tradingseconomics.com, just type in the price of rice. You can see in Japan, and you can see how the price of rice in Japan have risen. Okay, stocks, gold, and commodities could be the main beneficiaries. Why I say that in a hyperinflationary environment, people still go for stocks. Now, this is the Caracas stock market. Caracas is actually the Venezuelan stock market. You can see that when hyperinflation step in, it really go parabolic because people invest in stocks for the fear that inflation would deteriorate their purchasing power. Okay, so they actually invest in stock with the hope that the stock market would outpace the inflation. And this is another example from Argentina. This was during the period of hyperinflation. Then the current president got elected, come up with a lot of stringent policy, but his policy, while good at the start, but right now is causing inflation to spike again because he continued to borrow money from the IMF to put into his economy, resulting in higher inflationary pressure. So even though the stock market, you see they go up parabolic, but if you convert the growth of the stock market versus the growth in the price of gold, the stock market in the value converting to gold would actually go down. Okay, and that is why the best hedge, okay, against inflation will still be gold, which I will touch on later on. So let's look at the the Hong Kong stock market. Here's a comparison between the S&P and the HSI. You can see that the S&P during this period has gone up quite a lot, okay? From around here, it has gone up to here, okay, which is slightly around half of it to around 30K. Now that is many multiples, but correspondingly, if you look at the Hang Seng Index, it has barely gone back to its peak during the 2008 or before the pandemic. It is only half of that peak, whereas the S&P has continued to raise even higher. So that means that previously the S&P has been outperforming the Hong Kong market, but not now. And here is why. Now, since reaching a bottom in 2009, S&P has risen from 743 points to 5,958 points, which is equivalent to 709% gain. HSI has risen from 13,175 points to 23,345 points, equivalent to a 77.2% gain. So during the run-up since the financial crisis, the S&P has gained 10 times more than the HSI. So the HSI has grossly outperformed the S&P, but things are changing because this year, the Chinese government will unleash 1 trillion renminbi of stimulus besides other ongoing stimulus, which include massive trade-in programs for electronics and digital gadgets, high-tech equipment, and new energy vehicles. China continues to enjoy steady GDP growth in Q1 at 5.4%, with inflation at 0.1% in April. So whereas the US Q1 is actually negative 0.3% and inflation at 2.3%. So in US dollar terms, China exports surged by 8.1% year on year to 315.69 billion, while imports declined 0.2% to 219.51 billion, thus delivering a surplus of 96.1 billion, 1.18 billion. So that is why 2025, we could see the HSI outperforming the S&P. And as of 19 May, the HSI has gained 4,058 points, or 20.68%. S&P has gained 95 points, or 1.62%. So this goes to show that there is a changing market perception of the risk. From the US, right now people are more favorable to the Hong Kong market, or which is actually a de facto China market. The HSI has outperformed the S&P thus far. So if you look at it, the US or even most of the major economies, if you just look at their 10-year yield, the European bonds, the EU bond, Japan bond, Australia, Canada, Germany, France, US, all have actually gained year on year long-term bond. But despite the Chinese government massive stimulus, there was no pressure on its bond. You can see the 30-year Chinese bond actually fell down. Now, when the bond yields goes down, it means that there's a strong demand for the bonds. If there's no demand for the bonds, the yield would actually go up. So this goes to show that the general market opinion is that the Chinese bonds are more are safer than US 30-year treasuries. Okay, and this is painting a picture that people are not concerned about China's debt, people are not concerned about China's economy, but people are more concerned about what's happening in other major economies. And if we look at the gold market since the year 2000, gold has outperformed the Dow, S&P, and silver. Gold is up 1,008%. Silver is up 522%. The Dow is up 288%, and the S&P is up 325.3%. So if you are taking a long-term picture, this is how they fare. Okay, now why do I say starting from the year 2000? As I have always expressed that the year 2000 was when Alan Greenspan, being the Fed chairman, has unleashed his low interest rate monetary policy. And each time you see speculation going up before there's a disaster in the collapse of asset prices before moving up again, and then another collapse before moving up again. Whereas over the long term, gold has appreciated simply because the depreciation of the currency value. If you look in terms of ringgit, in 2018, I remember 2018 because I was doing a seminar for a brokerage firm. The gold then was about 100, less than 110 ringgit per gram. And today, you look at it, gold is 4 times up. Okay. Whereas the KLCI index, has been within a narrow range over the last few years. So on the major currency of the US dollar, since 1913, the US dollar has depreciated 99% against gold. That goes to show that central bank solution for every economic challenge has been to print money to stimulate the economy. And any printing of money to stimulate the economy will always have an impact on the value of gold, because it means that more printed notes being in circulation means that it creates inflation. And that's why gold has outperformed both the Dow and S&P. So why gold? As I mentioned, gold is the best hedge against global uncertainties brought about by the following: Trump tariffs, inflation, global debt spiral. Now, if you look at the global debt, just like I mentioned, that US 324 trillion, you may like to know that the global economy is only about 100 trillion. So the debt is already 3 times the global economy, which means that that debt will never be repaid. Okay, and with the uncertainties coming, with the tariff, the possibility of a recession, that means that on the possibility that central banks would need to print money again to overcome that recession, it means that the depreciation of currency would be even greater. So economic and financial shocks, this is precisely what I mean, and global geopolitical brinkmanship. Because of the risk between countries, people will always rush into gold because gold carries no counterparty risk. And more than anything, gold protects our purchasing power under the most adverse situations. So how gold is about to turbocharge. Now, since I had a similar discussion, we have a similar discussion on gold last year, I think gold has appreciated, but right now it's going to be turbocharged even much higher. Why? Because even after so many years, central banks are still the net buyer of gold for 16 consecutive quarters. So gold is being accumulated by central banks globally. Okay, Chinese government has mandated that major Chinese insurance companies must allocate 1% of their total assets into gold, which will gradually be increased to 5%. So in Q1 2025, insurance institutions saw their total assets rose 5.4% to 37.8 trillion. Now that 1% is equivalent to 378 billion going into the gold market. Now, if they raise it by 5% over the course of, I think, coming quarters, that would increase the money available to purchase gold to more than 1.7 trillion renminbi. Okay, so the gold market is only worth so much because it takes many years before gold is being extracted, and generally there is a lot of challenges in bringing high-grade gold to the surface. So the Shanghai Gold Exchange will institute offshore vaults to allow trade partners to convert renminbi into gold. So here is a report that says that SGE will establish gold delivery warehouse in Saudi Arabia for direct exchange of petroleum renminbi. Now remember the petrodollar story we touched last time. So right now China is saying that if you don't trust the renminbi, no worries, we will back it with gold. And at the same time, delivery vaults will be set up in Dubai, Singapore, Malaysia, and Hong Kong, which meanwhile accept gold pledge renminbi loan business. So these are the things that will turbocharge gold. And recently, the Shanghai government intend to sell gold to public via special discounts of up to 30%, valid until the 2nd of June. So that it will also drive more Chinese population to own gold. Now, even though the PBOC states in its profile that currently they own about more than 2,000 tons of gold, if you refer to the Shanghai Gold Exchange, amount of gold withdrawn from the Shanghai Gold Exchange since 2008 is right now hovering closer to 30,000 tons. Okay, that means within China itself, plus the PBOC, plus whatever sovereign wealth fund that the Chinese government has, and also in its huge banks and insurance company, that tonnage of gold could be worth more than 30,000 tons. So the ECB warned that gold markets pose a financial stability risk to its financial system. This is because too much demand for physical delivery could trigger stress across system. Now, this is not due to gold, but due to the financial system which has used derivatives to suppress the price of gold for more than 4 decades. So this is not a gold problem, but a counterparty problem. So in the works, BRICS is reported to be working towards a stable coin backed by gold. Several European central banks have voiced the need to revalue gold higher. Why? Because with the collapse of the bonds value that central banks hold as an asset means diminishing the reserves. So the only way to reduce the pressure on the yields is to revalue gold higher so that use the revaluation to pay off some of the debt, which will then bring down the yields in the bonds. So Trump administration is also reported to be working towards a gold revaluation to enable the US to accumulate Bitcoin as part of its strategic reserve. So these are the things that are happening right now. Okay, and here ends my presentation.
All right, thank you so much, PC, for sharing with us your view on the tariff impact to US, China, and even to the Hong Kong, right? So we've covered the performance of these indices across different markets. So right now, we'd like to move on to our next speaker who will share with you. Maybe PC can unshare your screen first.
Okay.
Okay. Okay, we'd like to move on to the next speaker, who is Afiq Suhaimi from Macquarie. So allow me to briefly introduce Afiq. So Afiq has been part of Macquarie Warrants Malaysia since January 2022 and is an emerging voice in the equity derivative sales team. He's involved in the issuance, sales, and marketing of structured warrants listed on Bursa Malaysia and is actively engaged in sharing his knowledge as part of the desk's ongoing warrant education efforts to help existing and potential Malaysian investors gain awareness and a solid understanding of these products. So, Afiq, over to you. You share with us how do we leverage on structural warrants to gain exposure, whether it's a bull market or bear market in the US market or even in the gold or HSI market, right? So over to you, Afiq.
All right, thank you, Shane, and thank you, PC. So for those of you who have stayed during PC session, if you want to ask any questions, we can just have the Q&A after my session. So you can ask any questions to PC afterwards, right? So the Q&A will be around 11:45 or 12 to 12, all right? So without further ado, I'll start my session. So today I'm going to talk about structured warrants. So why specifically structured warrants is because it is a listed product in Bursa Malaysia, which enables investors, retail investors such as yourself, to invest in different type of foreign underlyings or even in commodities without actually leaving Bursa Malaysia. All right. And the prices of investing in structured warrants, the capital that you need to invest in structured warrants wouldn't require you that much. So without further ado, I'll just go through some disclaimer first. That what I'm going to talk to you today is warrants, which has a significant investment risk, right? So and then the past performance that I'm going to show to you today is not indicative of any future performance, and the illustration is only for example purposes, all right? So what are structured warrants actually? So I've explained just now that structured warrants enables investors, retail investors, to invest in single stocks and index across different markets. So you can actually invest in index, KLCI index, and you can also invest in the Hang Seng market, the Hong Kong market, such as the Hang Seng Index, the Hang Seng Tech, and you can also invest in the US market via the index itself, which is the S&P 500 and also the Nasdaq 100. And you are also able to invest in the ETFs and commodities, among others, all right? So basically, warrant is derivative link product to equities, to stocks, index, ETF, or any other underlyings, right, in the market right now. So, and then a thing that made a structured warrant that is that people are trading lah. You can see that usually the volume of trading warrants it's high. So the thing that made it is because one of it is there is no margin call basically. So if you invest in structured warrants, the only losing that you would get is up until your capital, and then no more than that. There is no margin call when you invest in structured warrants. So this is as opposed to investing in options. So there are the difference there. Okay. Right, so the purpose of investing in structured warrants is to provide you exposure to different kind of underlying with a fraction of price, and the exposure comes with its own leverage, with their own leverage. So it's a leverage products. Right, so there are two different types of structured warrants in the market. You have call warrants and you have put warrants. So a call warrant is essentially a right to buy at a fixed price. This is an investment that you took if you have a bullish view towards the market or towards the single stock itself, right? And then how it works is basically assuming that every other factors are constant, right? The call warrant will increase if the underlying, which is the mother share or the index, goes up. It will increase if it goes up. So there's a direct relationship between its mother share. Right, and then how you actually detect structured warrants in your trading platform or in the market itself is but with the C and CW. So C and CW is call warrant. For put warrant, it's when you have a bearish view towards the market. All right, and you assume that all the factors are constant. The value of put warrant will increase if the underlying, the mother share prices goes down. Right, so this one, it has an inverse relationship with the mother share or the underlying that it's tracking. All right, so it's different compared to call warrant. And then example of how you can detect put warrant in the market is with H and PW, for example, NDAX HK or HSI PWD6. So these are just an examples, right? So as compared to company warrants, these two are actually different products. So what made it different is that company warrant is issued by the underlying company itself to raise capital, right? So you have something like from Encom Nilex who issued their own company warrants to raise their capital. But for structured warrants, it's issued by third-party financial entity. It's issued by banks or it's issued by issuers such as Macquarie. So we issued them for investors to invest in the market, right? It's an investment tool, okay? And then one thing that you would notice if you invest in structured warrant is there is a presence of market maker. Market maker is someone who provides liquidity to the market, right? Liquidity means whether that is a good warrant for you to invest in or not, okay? And then company warrant, there are no market maker because it's only issued by the company itself. And the difference, one of the most vital difference is actually the tenor. The tenor for structured warrants is a short-term trading outlook. So 3 to 12 months is usually the tenor for structured warrants that you will see in the market. But for company warrants, it's more of a long-term investment. So once you have like action on your warrants, right, up to 5 years, you probably convert it into an ordinary shares, for example. But for structured warrants, up to 12 months, and if you hold structured warrants up until expiry, you will get cash settlement if your warrants expired in the money. Okay. I hope that is clear. If you have any questions, don't worry, just post in the chat and I'll revert to it after the session. All right. So there are some variables that actually determine the warrant's value itself. The first is the share price, you understand. For call warrant, if the share price increase, the call warrant price will increase as well. And for put warrant inverse relationship, if the share price increase, put warrant will go down. But if the share price decrease, put warrant will go up. Right? So there's inverse relationship there. So share price is the first factor that would determine your warrant's value, the share price performance. Right. The second part is the exercise and strike price. So every warrant comes with your own exercise price or strike price. It's the same thing, but every warrant has it. And then these are usually fixed price. Okay. So if for call warrant, the higher the exercise price, meaning that the less likely the call warrant will be exercised. So meaning that your call warrant is out of the money. So for put warrant, the higher the exercise price, the more likely the warrant is to be exercised. So it becomes in the money. So this is vice versa, basically, right? And then the third variable that actually determine the warrant's value is the expiry date. So for both call and put warrants, a longer the time value there is, and hence the price of the warrant also increased. So a warrant with more time to expiry experience a lower rate of time decay. So time decay is a term that that every investor should know, because structured warrant is not meant for you to be held long term, right? It's a short term investment. So the longer you hold your warrants, the longer it is in your portfolio, right? The more time decay that you will actually collect. And then if it goes nearby the expiry date, if you hold until nearing the expiry date, the time decay will be sharper. Time decay will actually affect your call warrants. It will diminish the price of your call warrant or your put warrants, basically. All right. And then last one, we have volatility. So volatility, or as we actually call in the market, is implied volatility. It's used to compare the relative price of similar warrants, basically. The higher the level of volatility, the more expensive the warrants become. So just to share with you guys, implied volatility may increase if there's a market-related event causing uncertainty in the market. If there is if the US market tends to be volatile overnight, right? That there's a news of tariff happening. So that would translate to the changes in volatility of the structured warrants during the Bursa market hour. So, and also if there's an increase in the implied volatility of a similar option in the exchange traded option market or the OTC markets, then it will also translate to the volatility of the structured warrants. So basically, we are the issuer, market maker, or Macquarie itself, we are actually hedging the position of our warrants via the exchange traded option. So when we sell you structured warrants, we buy the options from the ETO market or the OTC market. So if the volatility of those options on the market changes, then it will affect the volatility of the structured warrants, right? So these are some of the variables that actually determines the value of your structured warrants, and you should actually know about that before you invest in structured warrants. Okay, so any questions on this, please feel free to post on chat. I am going to move on to some case studies. So basically, I'm going to show you how this warrant works, right? How the performance of the warrants are. So these are all real performance that happened in the market quite time ago. Okay, so first of all, let's look at HSI. So you can trade the upside HSI with call warrant. So I have, for example, CWGB, right? So the May futures from 6 May to 9 May increased from 1.1%, right? For this 3 days, right? 3 days period increased for 1.1%. And a call warrant, which actually follows the performance of the underlying, what do you think happens to it? What do you think happens to a call warrant when the underlying features increased? So basically, a call warrant will also increase as well, right? So when the underlying features went up by 1.1%, the call warrant over Hang Seng features actually went up by nearly 5%. All right. So this is assuming that all the factors are constant. Structured warrants can amplify potential profits through gearing, but they can also magnify the potential losses if the market moves against position. So basically, I'm going to show you, for example, what happens to your portfolio if you hold put warrants when the Hang Seng is bullish or is increasing, right? So this is another losing example. This is a losing example. Just now was a winning example. So your call warrant went up by 5% when the underlying went up by 1.1%. So what happened to your put warrant if you hold your put warrant when the HSI went up by 1.1%? So basically, it will go down, right? So it has an inverse relationship, right? So one thing about effective gearing that you need to know is that every warrant has its own effective gearing, and a 1% change in the underlying or the market share equals to the certain percentage of effective changes of the warrant. So for example, PWFR has a 10.7 times effective gearing. So a 1% change in the underlying share price, go up or go down, the warrant price will go up or go down 10.7%. So basically, that's what it means lah. Every warrant has its own effective gearing. Higher effective gearing equals to higher profit portability, but also it equals to higher risk. So it, like I said previously, structured warrant is a high risk investment. All right. So that was about HSI. Also, PC talked about gold, right? So as we all know, investing in gold is expensive nowadays, right? With the prices. So there is an alternative for you to invest or for you to invest in gold by actually gaining the exposure from the gold performance. So we have structured warrants, call and put warrants over gold. We are tracking the 2840 Hong Kong, the gold HK ETF. So it actually reflects the price performance of gold bullion without having to take physical delivery of gold. So let me take you to example of how the performance of our gold warrant has been. So I'm showing you on the left is the year-to-date chart of the 2840 ETF, the gold HK ETF, right? So year-to-date up until 17th April, it actually went up by 27.4%. And there is a period in up until May where it peaked to 22,500. Right, but this is until 17th of April. I'm just showing you until 17th of April. So what happened to the call warrant during the same period, right? So 2840 Hong Kong went up by 27.4%, but the call warrant over 2840 Hong Kong went up by nearly 300%. right? 285.7%. So this is a real life case studies, and this warrant has an effective gearing of 5.7 times. The 1% move of 2840, gold HKC5 actually moved by 5.7%, right? So that is the effective gearing, and it shows how much leverage there is in structured warrants. So, right. Okay, so the peak on 22 April, sorry, the peak on 22 April is 2,500. And then when the gold market the gold started to decline. So 2840 started to decline from the peak, down 7.4% to 19 May. So, and then the ETF, if you take from 7 May to 19 May, is down by 4.4%. So what happens if you think that gold market will be bearish, right? Or you short on gold? What happens then if you invest in gold HKH2? So basically, when the ETF, the gold ETF went down by 4.4%, the price of your gold Hong Kong put warrant went up by 23.5%. But this warrant has an effective gearing of 5.8 times. Okay, so yes, you can leverage both market directions with structured warrants. So when the market goes up, you can buy call warrants. When the market, if you think the market is going down, you can actually buy put warrants to leverage your position, right? You can also add warrant as a hedging tool. So I'll be talking more about hedging after at the end of my session, because I have some trading strategies on warrants that I'll be sharing to you guys, right? So before that, I'm also going to share with you on our warrants over the US index. So why should you trade US index warrants? Yes, the first is the bull and bear market. It's where you can trade both direction of the market. Like for example, the gold just now, you can also trade the bullish and the bearish market of the US index, okay? And then for the US index, it actually trades the US futures, which is trading for 23 hours daily, and it covers the full trading hour of Bursa Malaysia. Unlike the index itself, it only trades during overnight, right? So for you, because we trade the US futures, it also covers during the full market making hours of Bursa Malaysia, right? And then as you all know just now, there's a presence of a market maker, and we provide liquidity. So we provide liquidity up to 4 million for US index warrants. 4 million means it's easy for traders to sell or buy their positions. So if you are holding 4 million position or 3 million position, it's easy for you to go in and get out, instead of you investing in something that has very low liquidity, such as 200,000, right? 200,000 liquidity, but you're holding 2 million. Hard for you to go out, to get in and go out, right? So that is why the presence of market maker is important, and market maker plays a very vital role in structured warrants. Okay, so example of how you can identify US index structured warrants, for example, is SP500 C52. C equals to call, H equals to put. So put warrants, for example, is NDXHL, right? So the numbers are all just a series of or alphabet, just a series, because there's a lot of warrants over S&P 500 that has been listed. So right now, the current one is C52, and there'll be more, like for example C53 if we were to list more. Okay. Now over to the performance of the S&P 500 warrant. Right, so I'm showing you an uptrend from 22 April to 25 April. So just a few days period lah, basically. And then if you were to hold SP500 C52, when the S&P 500 index features went up by nearly 2%, your call warrant were up by 18.3%. So this warrant has an effective gearing of 9.6 times. So 1% of increasing in the S&P 500 equals to 9.6% of the S&P 500 C52. So it actually doubled, become 18.3% basically. So, yep. I hope you guys understand so far. All right. So just gonna talk through the NDX, Nasdaq. So we have two index warrants right now, S&P and also Nasdaq, and we have call and puts for all these underlyings. Okay. So for Nasdaq 100, the call warrant moved in similar uptrend to underlying, right? So this is from the 22 April to 2nd May. So from 22 April to 2nd May, the index went up by 1.4%. But in this few days period, the Nasdaq call warrant went up by 73.3%, right? So this is our all real case studies. It happens in the market right now, and you are able to buy call warrants listed on Bursa Malaysia using your own trading platform, right? You don't need to open any other international brokerage account, or you don't need to open an account with Macquarie because we are not a retail broker, right? So basically, you can use your own trading platform to trade structured warrants. These are all readily available, listed on Bursa Malaysia. So these are all case studies, are all real that I've shown to you, right? So other lists of foreign index or ETF that is offered by us includes Hang Seng Index, Hang Seng Tech Index. And we also have warrants over the Nikkei Stock Average, Nikkei 225. We have we have two ETFs right now. One is the Gold Trust that I showed to you, and we have the iShares A50 China ETF, right? So why should you trade warrants over index itself instead of just trading warrants over single stock, right? The first advantage is the broader market exposure. If Trump was to announce a new tariff news, so you are able to leverage on the broader market by buying call or put warrants, right? So if Trump announce some news that would make the market become bullish or bearish, you can buy call and put warrants. So you can actually have the exposure of the overall market, basically, right? And then you can diversify your portfolio. You can leverage on the bull, and you can leverage on the bear, right? And then no single stock risk. So when it comes to single stock, right, what happens when there is an adjustment or there's a corporate action, right, or there is maybe the underlying is on PN27 or something like that, right? So if you invest in warrants over index itself, there's no such single stock risk, right? Because you are actually tracking the overall broader market. All right, and then you are able to trade uptrend or downtrend, right, basically. So any questions, just post on the chat. I'll refer to it after my session. Right, so this is, I'm going to show you how you can actually trade warrants using our Live Matrix tools. So Live Matrix is the best friend of warrants trader. Okay, so for example, I have US index warrants that is active on Bursa Malaysia right now. So I have the September expiries, SPX and NDX. I have the June expiries, right? So for example, right now, if you were to choose warrants of the S&P 500 C52, right? Because you want to invest in some longer dated warrants, and then you have the capacity, you have the capital to do so, and you want something that is very sensitive. So if you look here, the lower the sensitivity means the warrant is more sensitive. Closer to zero means it's closer to the performance of the underlying itself lah, basically. So the lower it is, the more sensitive it is. So for example, C52 is one of the most sensitive S&P 500 call right now, right? So compared to C50, it's 14.6, this is 4.3. So you think you want to invest in sensitive warrant, and you want something that is longer dated because you don't want any time decay risk. So you invest in C52. So this is our warrant search. And then you open up another screen, which is our Live Matrix. So I'm going to show to you how you can enter and exit position using our Live Matrix. So firstly, you determine the entry and exit level for S&P 500 C52. So assuming that you wish to enter when the S&P 500 futures is at 5655, which is around here in the green box, and then you want to exit at 5675, which is around here, the sell green box here. So the entry and exit price will be at 880. You will buy warrants on the offer price because you want to buy in the 5655, right? And then because you are trying to exit at 5675, you've done your chart already, right? You want to sell here, you sell at 0.9. So basically what you did is you made a gain of 2.3%, while the underlying gain was only 0.3%, right? So that is what you call by leverage. So Warren is able to multiply your earnings by the effective gearing itself, okay? So this is on how to buy and how to sell position using Live Matrix. But you can also set a stop loss, similar to trading stocks. You can also set a stop loss for trading warrants. So basically, when you want to sell, when you want to set a stop loss is when you have bought warrants, right? For example, you've bought a warrant at 0.905, and the view of the market went wrongly lah for you. Okay, suddenly the market goes down to around here. So if you have already bought here and you want to set a stop loss at 0.875, so your last defense will be here, this green box here, right? So if you already bought your position here at 0.905 and you would like to set a stop loss at 0.875, right? So your last defense will be 565, 3.25. That's your last defense lah. Basically, that's how you set a stop loss using live matrix for structured warrants, right? So basically, for structured warrants, you also have to remember a few things. When you invest in warrants, you have to know the spreads of the warrants, right? So for example, if I show you S&P 500 C52, right, it has a spread of 0.005 here, between 0.895 minus 0.890 is equals to 0.05. Because warrants over 1 ringgit, the tick spread is 0.005. Warrants over 1 ringgit, the tick spread is 0.01. So 1 cent lah, basically. So half a cent for warrants below 1 ringgit. So when you invest in C52, you already know that this is tight spread because the spread is 0.005. But if you invest in C50, right, for example here, you have a difference of more than half a cent right here, from 0.100 to 0.130. You have a difference of 3 cents. So that is widespread. If you buy warrant on widespread, you will incur a higher trading cost. Why? Okay, if you buy warrants over tight spread 0.895, for you to sell back 0.895 is just few levels, right? From 565 on 50 to 5669 on 50. Just a few levels for you to make back what you invested in, right? For you to break even. Just a few levels. But if you bought widespread warrant at 0.130, you want to sell back at 0.130, the level there is higher. It's higher. So that's why you will incur a more trading cost if you buy warrant with widespread. So be careful. Just look at your warrant steadily. When you choose your warrant, look at it carefully, what the spread is, how long the expiry is. So if you have more questions on this, please feel free to post on chat. I know it can be confusing for first timers, but this is something that you need to take in mind when you trade such warrants, right? Please trade warrants that are only on tight spread. If not, you will incur higher trading costs. Okay, so to trading strategies, right? Right. So I'll share with you a few trading strategies that I think myself is very beneficial for warrant trading. So these are just like some ideas. These are not recommendation, but these are some ideas that you can use to trade warrants. Okay. So first of all, I need to introduce to you the concept of moneyness. So we talk about in the money and out of the money. So basically, for call warrant, in the money is when the underlying price is trading above the exercise price, right? For put warrant is the inverse relationship, right? For it to be in the money, underlying price needs to be below exercise price. If it's the other way around, they have become out of the money. So basically, you need to understand this in order for you to follow the strategies that I'm going to show you lah, basically. So the first strategy is protective put trade, or what we call as portfolio hedging. So for example, I'll give you a scenario. Before a high risk event, before Trump decision on US trade protection, or before he's going to go commenting on certain tariffs, right? And then, or if you think that the market is expected to become bearish because of this upcoming decision, right? And then you are holding certain position in an underlying or an index, for example, if you're holding the S&P 500 and you unwilling to sell your position, but at the same time, you still want to reduce the risk of the downside risk, the risk of your portfolio going down, basically. So what can you do, right? So the first strategy is you can actually consider to buy index put warrant to protect your US stock portfolio or US index portfolio. For example, you can buy put warrants over S&P 500s or the NDX, the Nasdaq that is listed in Bursa Malaysia. But if you're holding in the index itself or the US stocks itself, and you want to protect your downside movement, right, you can buy the put warrants over the index. So that's one way. right? So this way, you actually be utilizing a small amount of capital to protect against any downside move affected in underlying. Yes, you'll be investing in small amount of capital to buy the warrants itself, the put warrants, but you are able to protect your portfolio if the underlying goes down, right? If the because of the news, right? And then for you to follow this, for you to use this strategy is the technical indicators that you need is basically the moving average lah. So I have the 8-period moving average and the 50-period moving average. So the price of the mother share or the index underlying needs to stay below the 8 days moving average and the 50 days moving average, and you should enter when the price breakout is below the previous low. So enter means enter the put warrant, buying the put warrant when the price breakout is below the previous low. Okay, so you have the breakout here, right? So when it's going down here, breakout below previous low is when you should enter for the put warrant position for you to hedge your position, right? And then the warrant that you can go for is considered to buy slightly out of the money. So if you remember what out of the money means, basically, put warrant lah, out of the money is when the underlying price is above exercise price. So you buy warrant that is slightly out of the money with longer expiry date, right? There's a June expiry and a September expiry. Opt to choose the September expiry with longer expiry date, and you can hold warrant as a hedge until the event is over. So basically, why longer expiry date is because you want to minimize the risk of time decay, right? So you wouldn't know how long you're gonna hold your position for, but you want to minimize time decay. You don't want to lose your investment due to time decay, so you go and buy longer expiry date. All right, so this is one way of you to trade such warrants, which is by hedging using put warrants when you're expecting a market to have the downturn. Okay, this is one way. Right. Moving on to second strategy is when there is a bullish pullback. Right. So I'll give you an example of a scenario. You expect that the Hong Kong market to have a rebound after 5 consecutive days of losses, right? And then you have insufficient capital to gain substantial exposure. And then the potential strategy that you can use right now, if you want to get on the rebound, right, is you can consider to buy call warrants over Hong Kong index to gain the leverage exposure of the Hong Kong market movement. So by this, you are actually using smaller capital outlay by buying warrants because warrants are priced below RM1, right? You're using smaller capital outlay, and then there's no margin call. So the risk management that the technical indicators that you can use is you can enter position of the call warrants when the RSI or relative strength index is below 30, or when the 8 days EMA or 50 days moving average is wide between each other. So for example, this is where I show you lah. This is 50 and this 8 days. If it's wide in each other, and then you can see a breakout, first breakout, right? This is where when you can actually buy a call warrant over the Hong Kong index itself. All right. So for this, you need to choose warrant with higher sensitivity, and then you can also you can place a stop loss order lah, basically. I've shown you how you can place a stop loss order using the live matrix. I've shown you how you can choose warrant with by sensitivity using our warrant search. So and then this is the trading strategy that you can actually use, you can utilize to trade warrants, right? So this is an idea for you guys lah on how you can use structured warrants to leverage the tariff news, to leverage the market movement. All right. So I have the third strategy for you guys. If you don't understand, if you have any questions, just post on the chat. Okay. So the last one is the pre-earnings trade. So whenever there is an earning coming up, right? So you want to get leverage over position, but then you don't know what will happen to the stock movement after the earnings, right? It might go up or it might go down. So for example, I give you Alibaba. Alibaba had its earning about a few weeks ago. I think in 15 May, a few weeks ago. So a tech company is about to report earnings in volatile market. Alibaba is about to report earnings in the volatile market. So according to your analysis, you are expecting the stock to swing plus minus 5% after earnings, post earnings, right? So the strategy that you can use now is considered to buy a call warrant and also a put warrant over Alibaba, over the stock lah, basically, that you're looking at. So by this, you are able to capture both price movement if it goes up or if it goes down, right? So the risk management is you need to enter at least 3 days before the earnings announcement date. So usually when you go to somewhere like TradingView, they already stated the date of the earnings announcement, or you can also go to the exchange itself lah. You can see the date of the earnings announcement, and then you enter at least 3 days before the earnings announcement date, and you can choose at the money or slightly out of the money warrants for lower capital outlay. So out of the money warrants tends to be cheaper than in the money warrant. So that's why you need you can choose warrants that are out of the money or at the money for a lower capital outlay. So you can also choose higher sensitivity warrant for faster break even. All right. So even a smaller move in the stock price, if you choose a higher sensitive warrant, it will break even. It will move faster compared to warrants that are lower in sensitivity. So basically, that's what it means lah. And then you can set a stop loss order for both call and put warrants. For example, 10% down lah, basically. All right. I have a question here. For structured warrants, how do we calculate total point adjusted or time decay for non-working working day? So basically, you don't have to calculate this lah. You can actually calculate using the in our website. We have a structured warrants calculator. So that is for you to calculate your time decay warrants lah. But you don't need to manually calculate, but what you can do is that you can actually just refresh the live matrix. So it's actually auto calculated already lah. Just refresh the live matrix during the market out before the market opens lah. Right? Is effective gearing constant? No, effective gearing is not constant. Effective gearing on the warrant also depends on the movement of its underlying. All right. Is there any API from Macquarie structure warrant? API. I'm not sure what you mean by API, but you can actually just go to our website lah. Basically, just go to our website. The live matrix is for free, right? For free. All right. So if no questions on strategy, I'll move on to the advantage and disadvantage when it comes to trading warrants. So the first advantage is, yes, the gearing effect. You can see that each warrant has its own gearing, and it enables the warrants to move in a bigger percentage. Right. Second one is less capital. It requires less capital for you to invest in, and with using less capital, you can actually diversify your portfolio. All right, you can buy other warrants, other underlyings. You can buy ETF itself, index itself, right? And then at the same time, you can hold such warrants. So basically, this is one of the trading strategies that I actually told you about. And then exposure to foreign exchange, you can expose yourself to any overseas market in the Malaysia. And then you can also expose yourself to both the direction bull and bear market direction. So basically, there's a lot of advantage when you trade structured warrants lah. It's a very interesting product, right? But at the same time, there is a risk when it comes to investing in structured warrants. For example, gearing. Gearing is a double-edged sword, right? If you invest in something in a warrant that has high gearing, the probability for that warrant to multiply losses is also there, right? Because high effective gearing equals to high profitability, but also high risk, right? If your warrant can increase 10 times, it can also decrease 10 times, but you can only lose up until the capital that you invested in lah, basically, because there's no margin call when you trade warrants, right? Market risk is when there is news lah, basically, or trough terms news, or there's a US sanction, right? Basically, your warrants will move according to the market news. Warrants moves when there is volatility in the market. So during volatile market, warrant is actually a good product for you to look into. All right. So limited life is when it's what I talk about expiry lah. So every warrant has an expiry date. The longer you hold warrant, the more time decay there is. So better to just stick to short-term trading when it comes to warrant lah. Okay. And then exchange rate risk is basically when you invest in foreign exchange warrants, right? For example, Hang Seng, US index, there is FX risk probability, possibility that the warrant price will be affected by the fluctuation of currencies. So this means that your warrant price may increase or decrease due to the changes in the associated currencies, right? So just some Q&A lah. Basically, I have 10 more minutes, but just some FAQs. Sorry. Right, for warrants, right? How do I know if a share has high liquidity? So basically, if you look at stocks, right? For example, the higher traded volume means it's liquid lah, basically, for stocks. But for warrant, it's different. For warrant, you need to look at the bid volume and the ask volume. right? So a market maker actually provides liquidity in warrants by providing continuous buy and sell quotes for investors to enter and exit their position. So when trading warrants, liquidity corresponds more on the bid and offer volumes, as well as the price spreads provided by the market maker. So basically, warrants that are actually liquid are those with high bid volume and ask volume, not those with high traded volume, right? So why? Because even if you have high traded volume but low bid volume, such as call warrant Y, right? You cannot enter and exit position, right? If you're holding 2 million of position of Hang Seng Index right now, Hang Seng Index call warrant right now, if you invest in call warrant Y, right? Your bid volume and ask volume is so small that you need to queue a lot lah for you to sell off all your entire position. But if you invest in call warrant X with a bid volume of 2 million on bid and ask, right? If you hold 2 million, just you can sell it off quick, yeah. Just one time. So basically, that's what it means by liquidity lah. Liquidity means how much is the market maker able to provide on the bid volume and the ask volume. So the higher it is, the more you can actually buy and sell position in that warrant. So when you trade warrants, you don't treat it like stocks, because the volume of warrants doesn't necessarily mean that it's actually a good warrant, right? High volume traded warrant doesn't mean it's a good warrant, right? Look at the bid volume and volume that the market maker is giving right now, right? So in this case, call warrant X is actually the better warrant lah, basically, right? Because the bid volume and ask volume is higher, even though the traded volume is lower, right? So all the index warrants are tracking futures, not the cash index, right? So basically, Hang Seng is tracking the June futures right now. Hang Seng Tech as well. The Nikkei and the Nikkei is tracking the June futures, and when it comes to June, will change quarterly lah. So basically, this is the market making hours. You can actually screenshot this, or you can QR here. So market making hour is basically fixed lah. If there is any changes like half day trading hours, then we will post on our Telegram group lah. Right. So every warrants over index are actually tracking futures. So these are the rollover futures contract date. So basically, HSI and HSTAC will trade the month's future in the third last business day of the current month. So you can actually screenshot this, or you can follow our Telegram channel. So that is easier lah, basically. Okay. So for S&P 500 and Nikkei, it's a tracking quarterly contract. All right. So this is the link to our website. You can scan a QR code, or easily you can just Google Malaysia warrants and you can see Macquarie already, right? Macquarie is on top there. All right, and then for those of you who wants to learn the basic, in our website also we have Investor Academy. We have a lot of terms that we explain to investors lah, that if you don't know what the terms are, you can actually just go to the Investor Academy. And then for those of you who have lack understanding on English and you prefer Chinese language, you can go to our English Chinese glossary page. So basically the terms are translated into Chinese already, okay? And then most important part, these are all on our website. So, but the most important medium that we have also is the Telegram channel. So this is when we post updates, a lot of updates. All right. So can you explain on the sensitivity? Okay, Tony. Okay, I'm now at the Q&A session lah, Shane, just FYI. I'm done with my slot, but I'm just going to explain on the sensitivity part of the warrant, right? So I'm going to go, right? So just go to warrant search here. So basically, right, sensitivity means how sensitive the warrant is according to the movement of the mother share of the underlying index, mother share, stocks, underlying ETF, according to them lah, basically. So if you go to our warrant search, right, on our website, warrant search, if you have compared US indices, you choose US indices, or you choose Hong Kong index, or you choose any specific single stock, 99 Speedmart or EcoShop, for example, you choose and you press submit. You have this different type of warrants that are focused in that underlying that you chose. And then you have sensitivity. If you are a trader who wants to trade based on sensitivity, you will filter out using sensitivity. So sensitivity, when it comes to on the warrant search page, basically it means that the lower the figure is, the more sensitive it is. Basically what it means is that the closer it is to zero, right? The closer it is to the movement of the mother share. So sensitivity with 1 is very fast. Sensitivity 4 is still considered very fast. Sensitivity with 139 here is not sensitive anymore, right? So that's what it means lah, basically. So every warrant has its own sensitivity, and sensitivity derived from the exercise ratio, right? It derives from the exercise ratio, but also it also derives on the exercise price. So if it's too far out of the money, so it will not be sensitive. If it's in the money, like S&P 500, say 52, for example, in the money, right, or closer at the money, it will be sensitive lah. So that's what it means lah. So sensitivity is how much movement is the mother share compared to the movement of the warrant. So the lesser it is on the warrant search, right, the more sensitive it becomes lah. Basically, you don't have to go to warrant search. You can also go to the live matrix. It will tell you the sensitivity of the warrant itself. Right. All right. Thanks, Tony. Shane, let's go to Q&A probably. I can.
All right, sure.
I can stop sharing.
Thank you so much, Afiq, for sharing the tariff turbulence in the market. Be it whether it's you are bullish or be it whether you are bearish, you can also use call or put warrant to take advantage of the situation. Okay, so if any question to ask any of our speakers, you may write them at the Q&A box.
Right. If you have question for PC Wong, please write as well.
Yep. So maybe Afiq, would you want to go to your website to show them
Sure.
where is live matrix, because Jane asked where is live
Okay.
matrix? Yeah.
Okay. Sure. Let me share again. Right. So basically, this is just Google. What I do is Malaysia warrants. Malaysia warrants, right? The first one that appeared is just Macquarie already, basically. You can see my screen, right, Shane?
Yes, we're looking at
Right.
screen.
Okay. Right. So except here, under warrant tools is our live matrix. So I'm just going to right click, open in another tab, and then warrant search is also under the warrant tools. So basically, this is what I meant by warrant search. If you want to trade in Hang Seng warrants, Hang Seng index, right? So just submit here. So this Hang Seng, all Hang Seng index. If you prefer maturity that is 6 to 9 months or longer dated, right? You just press submit. We don't have one currently but if you 3 to 6 months, here it is, all the newly listed warrants. Sensitivity is here, basically. Yeah. So for live matrix, you have live matrix for specific warrants. For example, we have EcoShop. EcoShop just listed. DH. Here, this is the live matrix. And then the quick terms is when you can see basically all the terms of the warrants expiry, last trading date. If I go to S&P 500 C52, right? I can look here. Expiry, effective gearing is 7.9, sensitivity is 7.29. So for those of you who asked about warrant calculator, so this is it So you can actually look at the time decay You can actually calculate your time decay. So for example, you have one C52, right? S&P 500. Underlying level now is here, and then maybe you want to hold until like 14th of June, for example. Implied volatility, maybe there's an increasing because the market will be increasing by a few percent, right? So this is the simulated result of what we will apply to your warrants. So basically, this is a very good tool Basically, the number one tool is actually live matrix, still live matrix So this is what you use when you want to invest in structured warrants. Right.
Right. Thanks, Afiq. So we have a more intermediate question coming from this gentleman called Shun Ken. So Afiq, just now you taught the straddle and the strangle strategy, which is your third strategy The straddle and strangle strategy. 3 days prior to the earnings, so we buy a call and buy a put simultaneously. 3 days prior to the earnings. So, but what about the implied volatility spike and crash following the earnings? Will Macquarie adjust the IV?
That would depend on the movement of the market, yes. But I would say it's not something that is fixed It's not that all the time we would adjust. But if there is a sharp increase or sharp decrease in volatility, yes, that is when we will adjust. But for example, if that okay, so this is pre-earnings lah, basically. For 3 days before earnings, usually we only adjust when there's a sharp, when the situation has already happened lah. Basically, like post earnings, right? There's a sharp decline, so then we will adjust it accordingly. Right. I hope that explains.
All right, thanks, Afiq. So the next question by Jane is, what is the active trading period for put warrant before it expired?
Active trading period depends. Every warrant has their own terms. Basically, so some warrant has 5 to 6 months, 3 months. 3 months is the minimum for put warrants. But yeah, it depends. So FYI, do not trade warrants that are nearing expiry because of the risk of time decay lah. But every warrant has its own expiry date. So you need to see on your platform lah, basically.
All right. So now just like I mentioned that put is very similar to shorting the shares, right? So where put will appreciate in value if the underlying price goes down. So the question next is, how do we estimate what price to enter the put?
So that depends. Now that depends on your charting lah, basically. You still have to do your own technical analysis of where the price movement of the underlying will go. So when you trade warrants, you don't actually refer to the underlying chart. You don't refer to the warrants chart. You refer to the underlying chart itself, right? So you don't refer to the warrants chart. So you refer to the underlying chart, and then using the live matrix, wherever you think the price of the underlying will go, then you use the live metric and see where will the price of the warrants will go. So basically that is the usefulness of live metrics. It's transparency in showing you where the prices will go if the underlying goes at that price.
Yes, that's right. That's why Macquarie has their own live matrix for you to know what's the right price for you to get out, right? So but bear in mind that every issuer, they can only track their own issue warrant lah.
Yeah,
So
correct. For live
if you want
metrics,
to yeah, if you want to see the live metric of other issuers warrant, then you have to use the other issuers live metric, yeah.
Yep.
Okay, so then the next is, so what do we consider to analyze before we decide to trade a put? So that's the next question.
Yeah. If you want to trade put warrants, you need to consider your analysis on the certain underlying lah. Basically, if you think that it's bearish, then yes, please go ahead to trade in put warrants. So, but before you trade the put warrants, few things you need to understand. So, if I just show my screen lah, basically, right. So, if I just show you my screen lah, warrant search. So, the first thing is you need to understand when you choose your underlying, for example, S&P 500 lah, or just US index lah. Basically, so you choose the underlying, and then you want to choose put warrant, right? Because you think it's bearish, and then after that you need to choose you need to see the level of effective gearing that you are comfortable with. Higher effective gearing equals to high risk, but high profitability. So let's say that you want something that is around 10 to 15 times effective gearing lah. So you have this NDX HK put, right? So, and then you also have to see whether the bid volume and ask volume is high or not. So if you go back to all effective gearing, if you compare the bid and ask volume, we can see that those with 3 million is actually the focus warrants that Macquarie is willing to sell, just because it's a warrant that is better than the other warrants lah. Basically, that's what we think lah. But then it's also we're giving you a higher liquidity in that warrant. So 3 million means in the bid volume and ask is you are able to sell your position up to 3 million on the bid. You're able to buy up to 3 million on the sell, right? So that's how you can choose warrants lah. When you choose put warrant.
All right, so this time you taught us about strategy, right? So when it comes to setting stop loss, right, how would you advise retail investors to set stop loss when it comes to trading warrants?
Maybe as you can, similar to stock lah, maybe 10% or 15%. So that depends on your comfortability, right? On the risk that you are able to hold also. So it depends on yourself. I cannot tell you what point you should set a stop loss. Depends on yourself lah.
All right. So the next question is by Philip, right? Gold being a commodity product, right? What causes its volatility and the fluctuation of the gold price? Maybe PC you can answer that.
Yeah.
Now the gold is no longer considered a commodity product. In fact, according to Basel Rule 3, gold is now considered a tier 1 asset, which means it is as good as cash. And if you look at it, a lot of states in the US right now have put into bills that would treat gold as a monetary asset. So there is now a changing perception on gold. So gold is not a commodity anymore. Okay, so the fluctuation in its price will depend. Previously, fluctuation of price previously was dependable on what was going on in the COMEX, where the futures market, and the London Bullion Market, LBMA Market Association. Okay, where the COMEX will sell the futures and LBMA would deliver the gold. But subsequently in 2020, the COMEX suddenly broke its so-called cash settlement rule, where there was a sudden surge in demand for gold, and COMEX started to deliver more physical gold. Previously, it wasn't so much. So right now, according to the news coming up from the LBMA, physical gold delivery is being delayed by several weeks, which means even the LBMA does not have the amount of physical gold to meet the delivery challenges that is right now animating across the gold market. So the bullion banks have been trying to suppress the price of gold. But right now, because of their price suppression, they are sitting on a total net paper loss position in their net short position amounting to almost $60 billion. So they need to get out of that as well. But meanwhile, there's a lack of physical gold because countries that are in Eastern Europe, including Russia and China and India and some Southeast Asian nations, are actually buying gold. Okay, so that means that the bullion banks have failed to suppress the price of gold, and the shortage in physical gold, because the LBMA delivery right now takes weeks instead of just a few days, goes to show that there is a potential for gold to move higher. But if you adopt a long-term view, as I mentioned in the chart, gold has actually been the better performer, especially in the 12-month period since last year. Okay.
All right. So is gold still on an upward trajectory? What is your view on this?
I think it will be on an upward trajectory simply because just now in the presentation, I mentioned that the events that will turbocharge gold, because increasingly China is asking the insurance to allocate 1% of their total asset into gold. Now that is currently only 387 billion renminbi, which will gradually be increased to 5% across several quarters. So that means right now another 1.7 trillion renminbi can potentially go into the gold market to buy physical gold. Now China SGE doesn't trade in a cash settled futures. All settlement must be in physical gold. Okay. And that is the reason why there's a lack of physical gold right now.
Okay. Now we know that the gold close to all-time high right now, but the Malaysia gold-related stocks did not really react similarly. What could be the reason? What's your view?
Now there are the Malaysian gold companies. I have studied one in particular. They do not fully adhere to the reporting of major gold producing companies. For example, those companies in their presentation, they would disclose what is their cash cost, what is their AISC, and what are their reserves, whether they are in proven and probable, whether they are measured and indicated, and such. So that is why a lot of people who are unaware how the gold companies are measured against, they just see the gold price go up, they try to go into Malaysian gold mining companies. But a lot of these companies do not fully follow the kind of presentations or reporting that major gold companies are. But right now, the gold market, even though gold has gone up, the miners are doing quite terrible as well, because there are two types of gold market for companies. One are the producers. The next one are the junior producers or explorers. So I believe most Malaysian companies are either in the junior producer or in the explorer category, which doesn't get the kind of top billing like the major producers. For example, some major producers in the US have seen their price go up, I think, over the last 10 years, from $1 plus to right now, 10 US dollar. Okay. Some at let's say $4. Right now they are trading at 15 or $17. So the market is moving towards the major gold producers, but the junior producer and the explorers will have their time when the major producers starts to realize that they need to acquire new gold deposit. That is when they will actually do major acquisition. So the acquisition price for explorers can be multiples higher. For example, during the last gold bull run in the 2011, you will be surprised that some major producers are willing to pay $500 per ounce of gold in the ground, which means it has not been extracted yet. But after the 2011 bubble burst, and a lot of major producers are suffering major losses because of their over acquisition in cost, a lot of the junior producers have actually fall out of favor. So right now, the junior producers, they are barely starting to rise. Okay, hopefully, this kind of rise in junior producer will spill over to Malaysian gold companies. But as I mentioned, I've studied one in particular. They do not follow closely what other international gold mining companies are doing with regard to their reporting. So everything is actually not up to date. For example, a junior miner company, which I do own, that is listed in Australia, they will actually tell how many kilometers of drilling that they are doing in the current quarter, and how much indicated and measured resources there are, so that investors know fully what is being done. For the lack of such news, okay, therefore the investors' interests are not there. So they only come in when there's a reporting of the earnings, and if gold price rises, they make a good earning, then they will sell after a while because they sell on the news. But if the company will report how much they're going to spend on drilling, their capex, what is the all-in sustaining cost, what is the cash cost, then international investors would be more willing to participate. Hope that answers your question.
All right, so that's all the time we have for question and answer today. So thank you so much to both gentlemen for joining us in this webinar to discuss about how do we navigate tariff using structured warrants, how do we position ourselves better to make better informed decisions in this navigating in this turbulent world. All right, so our next webinar with Macquarie is happening on 26th of July 2025. So the title is Technical Trends in Asian Equities. So you'll see you in less than 2 months. So if you're keen to join for this session, where our speaker will share with us what are the trends like in Asian equities, including Hong Kong, including Japan, including Malaysian market. So what are the counters that are on the breakout right now? So you can join us in this webinar. So you can register first so that you'll be the first in the loop to receive the invitation to join this session. With that, thank you everybody, and hope to see you guys in our next webinar with Macquarie. Bye bye.
Thank you,
you,
Shane. Thank
everyone.
you, Afiq, and all
Thanks,
who
PC.
lock in for today's session. Bye bye.
Bye.